Welcome to The Economy. How do you measure that? The podcast that dives into how we measure all the things that make up the modern economy, from donuts to derivatives, one transaction at a time. I'm your host, Jim Tebrake, Deputy Director of the IMF Statistics Department. Today's topic, monetary gold. How do you measure that? When we think of gold, we usually picture jewelry, Olympic medals, or bars sitting in a vault somewhere. But not all gold is created equal, at least when it comes to economic statistics. There's a special category called monetary gold, and it plays a unique role in how we measure a country's wealth, reserves, and international financial position. To help us unpack this glittering concept, I'm joined by Jannick Damgaard, a balance of payment statistics expert at the IMF. Jannick, let's start with the basics. So I have two imaginary bars of gold. I couldn't, this show doesn't have a lot of funding, so I could only get the imaginary bars out of the vault. But one of these bars we call monetary gold, the other one we call gold. What exactly is monetary gold?
Well, so most gold would be the non-monetary gold. So gold you see in jewelry or that is used in industry. It's non-monetary gold, and it's just treated as a commodity in macroeconomic statistics. So the concept of monetary gold is different, and therefore it also treated differently in the macroeconomic accounts. So it refers to gold that is held by central banks or monetary authorities as part of the official reserve assets. So you can think of monetary gold as the VIP version of gold. Only central banks can have it.
Okay, so gold, the commodity, is in my wedding ring. Monetary gold, that sits in a bank vault?
Yeah.
Central bank vault, I guess?
Yeah, exactly. And because it's different, it's also treated different in the accounts. According to the international statistical standards, it is recorded as a financial asset with no corresponding liability.
Okay, so you're a statistician, a balanced payment statistician. You have to measure this monetary gold. Because my first question is, well, how do you value that? Like, what's the value of that gold?
Well, the value of the gold, we use the market value for statistical purposes. So what statisticians will do, they will look at the market price of gold in the gold markets. So that is typically measured in US dollars per troy ounce. They will use that price and apply it to their own gold holdings, and that way they can estimate the value of their own gold holdings.
Okay, so what you're telling me is the price of gold, the commodity, is the same as the price of monetary gold. They're essentially the same price. You use the same price to measure these? Exactly.
We would use the same price because what central banks can do is they can sell their monetary gold also to non-central banks, and that is the price. That's the money that they could get. So that's how we value assets in economic statistics.
So the market price. So you also mentioned something about international reserves. Like what's the connection between monetary gold and international reserves?
So monetary gold is part of the international reserves. So you also have other components. You have foreign currency holdings, you have special drawing rights or reserve positions in the IMF, and this is just one part of the reserve assets. So monetary gold has some very attractive characteristics. So one, it's highly liquid, it's universally acceptable, and also it carries no credit risk. And I should also say that monetary gold is the only financial asset that does not have a corresponding liability in macroeconomic statistics.
Okay, so gold, certainly it's important. It's got all these really nice characteristics, but gold's not the only precious metal that has those characteristics. Silver has those characteristics. Why gold and not silver?
That is true, but gold has historically played a very important role in the international financial system. Back when we had the gold standard, you could actually take your paper money to a bank, and then you could get a fixed amount of gold in return. That helped anchor the financial system. You couldn't do that with other metals. So From a historical perspective, gold has had a different role, and it's still held by central banks all over the world.
So does that mean I can take $20 in my wallet? I can walk down to the Federal Reserve here in Washington and say, hey, I'd like some gold in exchange. Is that how that works?
I'm afraid to give you bad news here, Jim. It doesn't work like that anymore. So today we have fiat currency, and that is money that has value because it's backed by the government and it's generally accepted by the public, and not because you can go down to your local bank and get a fixed amount of gold. So unless your local bank moonlights as a pawn shop, I'm afraid you can't get gold.
Right, so gold plays an important role in the financial system, but not in our wallets.
That's exactly right. Monetary gold is a central bank asset, not something that households can claim. So it helps anchor the financial system, not your savings account.
Well, I really appreciate you clearing this up because, yeah, it's always been a little bit confusing why essentially the same thing, we give it two names and we measure it in two different ways within our macroeconomic statistics. So to wrap up, monetary gold is gold held by central banks to support the domestic currency and meet cross-border financial needs. It's treated as a financial asset, not a commodity. It's part of a country's official reserves and supports international stability. And no, you can't swap your paycheck for a gold bar at the bank. Thanks to Jannick Damgaard for helping us understand how this ancient metal is still playing a modern economic role. That's it for this episode of The Economy. How do you measure that? If you liked what you heard, subscribe and share. And remember, behind every central bank vault, there's a statistician like Jannick trying to figure out how to measure it.